Hello everyone, welcome to EduTap and welcome to today's monthly current affairs revision session where we are going to revise the important RBI notifications and the RBI press releases from May 2025. Okay, so this is going to be a very important session, as you know that if the examination happens in September, if the examination happens in October, the May notifications and the May press releases will be very important. Okay, so we are going to have the discussion and we are going to have the revision of the RBI notifications and RBI press releases. Let's see how many of you are able to answer all the questions or maximum of the questions. Okay, so this session is very important for all of you for your revision, to see that where you are making the mistakes. If you are giving the wrong answers, why is it so? Do you not have the clarity of the topic, or is it because of some silly mistakes? So this session will help you in understanding your mistakes that you are making in answering the questions. Okay, so let's get started, but before that, give me a thumbs up if I'm clearly audible and visible and everything is fine. So let's start with this session. Okay, so now before going forward, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So starting with the first question. Good evening everyone. Yes, so starting with the first question, try to answer this question. Let's see how many of you are able to answer this question. So we are revising the RBI notifications, we are revising the RBI press releases, and this is directly related to your RBI EduTap document that is getting provided to you in your course. Okay, so if you have the RBI EduTap document and if you want to revise that, okay, do you remember the topics that you have studied? So for your revision for the RBI EduTap of May 2025, for that also this video is going to be very helpful for all the course students. And if you do not have the course, then still you can see that what are the important topics and you can revise through this video. Okay, so this is the first question, that is saying that the Reserve Bank issued the framework for recognition of the self-regulatory organization in the financial market that is regulated by the Reserve Bank of India. Which of the following organization has been recognized by the Reserve Bank of India as a self-regulatory organization in financial markets regulated by the RBI? So which organization is it? Yes, I'm getting the right answer from all of you. It is the FIMDA, that is the Fixed Income Money Market and Derivatives Association of India. Okay, so this was the notification that was released in May 7, 2025. That is in May 2025. It was said that under the framework for the self-regulatory organization for the financial markets under the Reserve Bank of India, so the FIMDA has been selected as the self-regulatory organization. Okay, so this is the idea. I have taken a session on it also. Now the next question is in regards to the SRO framework, the self-regulatory organization framework for the financial markets. And here the SRO, basically the self-regulatory organizations, they work as the middle ground for the Reserve Bank of India, and they connect the Reserve Bank of India with the financial market intermediaries, with the financial market participants. Okay, so the SRO, that is now the SRO, FIMDA is the SRO now. So FIMDA in the financial market will be a connecting point for the RBI with the financial market participants, and will take the problem of the financial market participants to the RBI and will help RBI to regulate the financial market intermediaries. Okay, so here which of what is the answer? As per the framework for the SRO for the financial market, the applicant must have minimum net worth of INR how much? Very good, 10 crores. So the answer here is 10 crores. Okay, so the SRO framework is released for the fintech, for the account aggregators. There is also omnibus framework, that is for the banks and such. Now there is SRO framework for the financial market also. So remember the net worth in each of the SRO. Okay, and now they should possess or have the ability to create infrastructure to enable the discharge of their responsibilities to connect the RBI with the financial market intermediaries. So here the net worth that is required to become a SRO in the financial market, so that is 10 crores. That is 10 crores. Okay, so this we have discussed. I have taken a complete session on the SRO for the financial market. So if you want to have the detailed understanding of the SRO in the financial market, this session you can see. Otherwise, I hope you know the basic idea of the SRO, that they are the connecting ground between the RBI and the regulated entities. Okay, now the most important point here is of the net worth, as well as that these SRO, they will be the not-for-profit organization. That means they will be under Section 8 of the Companies Act of 2013. Okay, that is the idea. Now coming to the next question. So here the RBI has recently released the 44th half yearly report on management of foreign exchange reserves for October 2024 to March 2025. As per this report, a portion of the Reserve Bank of India's gold reserves was held in safe custody overseas. So which of the following institutions were entrusted with the responsibility? So which of the following entities or the institutions have been given the responsibility to handle the RBI's gold reserves or to hold a part of the RBI's gold reserves? So here try to answer the question. Okay. Yes, it is Bank of England and Bank of International Settlement. So everyone has given the right answer. So here the D is the right answer. Now 44th half yearly report, again we have discussed this report in detail regarding the management of foreign exchange reserves. But now the data points here, if the data points are, let's say, for March 2025, now the foreign exchange reserves data for the June, for the July has also been released. So here you do not have to focus too much on the data. Okay, you can see the data for the IIP, that is for the investment position, and you can see the data for the foreign portfolio investment in this report. But remember that this data has been given, the final data has been given in the yearly report also. In the yearly data points have also been released, so the half yearly becomes less important now. But the static points are important because a direct question, like in the last year there was a direct question that where the RBI is holding its gold. So it is in Bank of England and the BIS in the overseas areas. Okay, so this is the idea that you have to remember the static points, that the RBI also keeps the gold in the Bank of England with the Bank of England and Bank for International Settlement, but the data points have become less relevant now. Just have the overview of this 44th half yearly report and just remember the main data points. Okay, that's it, because the half yearly data is now not very much important as the yearly data has already been released, okay, for the investment and such. Now coming to the next point, that is the Reserve Bank of India had issued framework for formulation of regulations which outlines the broad principles that RBI will be following while formulating the regulations for the different regulated entities. So now as per this formulation of regulation guidelines, a minimum of days has to be provided for stakeholders and the public to share the comments. So if RBI is preparing the guidelines, the draft guidelines are released and the comment is taken from the public, from the stakeholders. So how many days are given to the public to give the comments? So it is, yes, 21 days are given. So here the answer is B. Okay, so this is the idea. So you have to cover the RBI notifications and RBI press releases of minimum 5 to 6 months. So minimum 5 months of the RBI notification and press releases you should be covering. Okay, the recent 3-4 months are the most important, but minimum is 5 months of the RBI notifications and RBI press releases. So we have discussed about RBI release framework for formulation of regulations, and in this framework, the main idea here is that the bank shall provide at least, the RBI shall provide at least 21 days to the stakeholders and the members of the public to submit their comments on the draft guidelines. Okay, this is the idea. Now coming to the next question, this is in regards to non-resident investment. So non-resident, they invest in our country, right? They invest in the corporate debt securities, they invest in the government securities, they invest in the state government securities also. So when the foreign portfolio investors, they are investing in corporate debt securities, so there is certain guidelines they have to follow. Now some of the guidelines have been repealed, have been taken back. So which of the statement is correct in regards to the guidelines or the statements that have been taken back by the RBI? So that you have to tell. So basically, according to the master action for the non-resident investment in debt instruments, there was the master action that was released in January 2025. Now recently in May 2025, it was said that the short-term investment limit and concentration limit has been repealed. So in May 2025, it was said that the short-term investment limit and the concentration limit for the corporate debt securities have been repealed, have been taken back. So which of the following statement is correct in regards to the earlier limits that were earlier, now they have been repealed? So basically, under short-term investment limit, investments by an FPI in corporate debt securities with residual maturity up to 1 year shall not exceed 30%. So it was 30%, okay, of the total investment of the FPI in corporate debt securities. The short-term investment limit shall apply on investment on an end of the day basis, correct? Investment in corporate debt securities by the FPI, including its related FPIs, shall not exceed 15% of prevailing investment limit of these securities in case of long-term FPIs and 10% of prevailing investment limit for other FPIs. Okay, so this is the idea that the concentration limit and the short-term investment limit has been repealed, but these were the limits earlier. It was not 20%, it was 30%. Okay, and the concentration limit was 15% for the long-term FPIs and 10% for the other FPIs. So here the second and third statements are correct, and that's why the answer is B here. So here you can see that in January 2025, we have discussed the detailed guidelines. In January 2025, we discussed the detailed master direction for the Reserve Bank of India, non-resident investment in debt instruments in the debt securities. Now the two limits have been repealed, that is the short-term investment limit for the corporate debt securities and the concentration limit for the corporate debt securities. They have been repealed. Okay, so before the limits were short-term investment limit of 30%, it should not exceed 30%, and the concentration limit should not exceed 15% for the long-term FPIs and 10% for the other FPIs. This was the idea. Now coming to the next question, that is RBI has released the Reserve Bank of India Digital Lending Directions 2025. This is important from static and current affairs point of view, and these directions have been released in May. So May, June, July, August, September. Okay, so 5-6 months of current affairs you should be doing, or 5-6 months of your RBI notification, RBI press releases you should be doing. Okay, so RBI has released Reserve Bank of India Digital Lending Directions 2025. As per the directions, the borrower shall be given an explicit option to exit a digital loan by paying the principal and the proportionate APR, annual percentage rate, or without any penalty during an initial cooling period. So in the when the loan is given, there is a cooling off period. Now what is the minimum cooling off period that the RBI has mandated? 1 day. Very good, correct. So 1 day is the minimum cooling period that has been mandated. So cooling off period cannot be less than 1 day basically. So here I have discussed the complete digital lending directions, and I had directly provided you the highlighted PDF. So where we had discussed that the cooling off period should not be less than 1 day, as well as we had discussed that if there is the complaint that the customers have against the digital lending platform, against the lending service provider, so the complaint has to be resolved by the regulated entity within 30 days. So remember that the complaint has to be resolved within 30 days. Otherwise, if the complaint is not resolved within 30 days, the customer can go to the ombudsmans, the RBI ombudsmans. Okay, so this is the idea. Now coming to the next question, that is the regulated entity may enter into default loss guarantee arrangements only with the lending service provider or other regulated entity engaged as a lending service provider. So when we were discussing the digital lending guidelines, we also discussed the default loss guarantee. Okay, so now the regulated entity may enter into the default loss guarantee arrangement only with a lending service provider or other regulated entity that is working as the lending service provider, that is providing these digital loans and such. Further, the LSP providing the default loss guarantee shall be incorporated as a company under the Companies Act of 2013. Which of the following statements is or are correct in regards to the DLG? That you have to tell me. In regards to the default loss guarantee, which of these statements is correct? So this default loss guarantee was discussed in the digital lending directions. So I'm getting the answer C. Is it correct? Okay, so most of you are answering C, and remember that for each question give yourself 1 marks. So whichever question you are answering correct, give yourself 1 marks. So here regulated entity shall ensure that the total amount of DLG cover on any outstanding portfolio which is specified upfront. So upfront, if the DLG, default loss guarantee, is given, that should not exceed 5% of the total amount disbursed. Absolutely correct. The regulated entity shall invoke DLG within a maximum overdue period of 120 days. So Nitya has given yes, 120 days. So it should not be overdue period of 120 days, basically not 90. Regulated entity shall accept DLG only in the form of cash deposited with the regulated entity, fixed deposit maintained with a scheduled commercial bank, that is with a lien marked in favor of the regulated entity, that the regulated entity can access if the default happens. If the loan is defaulted, then the regulated entity can access this fixed deposit against which the guarantee is given. The bank guarantee in favor of the regulated entity. So the second and the first and third statements are correct. The second is wrong, and that's why 1 and 3 is the right answer here. Very good, everyone. So this like in the digital lending guidelines, we discussed about the default loss guarantee, eligibility as default loss guarantee provider. We discussed about the cap, that is 5% if the upfront of the DLG is given, as well as invocation and tenure. So tenure is that a regulated entity shall invoke DLG with a maximum overdue period of 120 days, not 90 days. This is the idea. Now coming to the next question, that is regarding your liquidity coverage ratio. So there are changes that has happened in the liquidity coverage ratio. What is this change all about? What are the data points here? Try to answer this. So if you are studying RBI EduTap that is provided in the course, then you can see that most of the important notifications we have already covered in the Finance 360-degree session. If you do not have a course of ours or any other institution, then also you can see that most of the difficult notifications we have already covered in the Finance 360-degree session. Okay, so that is good for you, that you are like doing the regular coverage of the most important notifications and press releases. So the extent of LCR framework for banks in India has been reviewed in light of recent developments, because recently what has happened that the internet banking and the UPI ecosystem and the RTGS, NEFT, these kind of digital systems that we have, we are able to transfer the money very easily, and we are withdrawing the money very easily also from the bank account to pay to the merchants and such. So you can understand that it is leading to the runoff of the deposits, that is leading to the easy withdrawal or easy transfer of the deposits. So it can create a problem for the bank, because bank is expecting that okay, in this month only 50,000 or is going to be withdrawn. But let's say that people are able to do such easy withdrawal that as soon as we have a bad information about this particular bank, we will start with we will start doing the transfer of the money from this account to another. Let's say I have a bank account in XYZ in which I have 50,000 rupees. I have another bank account in ABC where I have only 1,000 rupees. So as soon as I get an information that okay, XYZ is a weak bank and the financial condition of the XYZ is not good, so I will be afraid and I will transfer my money from this bank account to the other bank account. So you can understand that it is very easy. It has become very easy to transfer the money, to take out your money from a bank. So runoff factor, the deposit withdrawal factor or the runoff factor has increased. Okay, so now it has been said, as per the updated guidelines, a bank shall assign an additional 2.5% of runoff factor, that is deposit withdrawal factor, for retail deposits which are enabled with internet banking or mobile banking or with the digital facilities. That is the stable retail deposits. Stable retail deposits like the employee accounts that we have in the bank. So all the employees, they have a bank account in a particular bank, right? So that is a stable deposit that is happening in that bank, because the employees, they always, like every month they will get their salary, they will keep this maximum of the salary in the bank account only. So that is a stable retail deposit. This enabled, so if the stable retail deposits, they are enabled with the internet and mobile banking, they should have a additional runoff factor of 2.5%. So what will be the total runoff factor for the retail deposits? And the next stable deposits enabled with IMB, enabled with internet and mobile banking, they shall have the additional runoff factor of 2.5%. So what will be the total runoff factor for them? Try to answer this. Very good. That for the stable retail deposits, basically for the stable retail deposits, the runoff factor previously was 5%. So additional of 2.5%, that will be 7.5%. And the less stable deposits, they had the runoff factor of like 10%. Yes, they had the runoff factor of 10%. So plus 2.5%. So they will have the runoff factor now at 12.5%. So this is the basic idea. E is the right answer. Okay. So before they had the current runoff factors, or before they had the runoff factor, stable retail deposit 5%, less stable retail deposit 10%. So now revised runoff factor is 2.5% additional. So now stable deposits with IMB 7.5%, less stable deposits with internet and mobile banking, that is 12.5%. So liquidity coverage ratio is actually the stock of high quality liquid asset that the bank is maintaining. High quality liquid asset means the cash, the government securities, the highly liquid government securities. So the stock of high quality liquid asset that the bank is maintaining against the total net cash outflow that is expected over 30 days. So in the next 30 days, there is the net cash outflow that is expected, that okay, this much of the withdrawals can happen. So against that expectation of the net cash withdrawal in the coming 30 days, there is the stock of cash and the high quality liquid assets that the bank maintain. So that is liquidity coverage ratio. Okay, so this all we have discussed in this session where we discussed the LCR review by RBI. Okay, so now coming to the next question, that is your 9th question. Try to read the question and try to answer this question. Now again, this is a very important topic where it was said that there is the revision that has happened of the economic capital framework. So all the data points in regards to the revised economic capital framework, all the data points are very important in this regards. Okay, so here basically, based on the revised economic capital framework and taking into consideration the macroeconomic assessment, the Central Board of Reserve Bank of India decided to increase the contingent risk buffer to 7.5%. Yes, B is the right answer here. Yes, very good. 7.5% for the 2024-25. So basically, in the annual report also we have discussed this contingent risk buffer, that RBI maintains the contingent risk buffer, and after that whatever money is left from its profits, that is shared with the government. Okay, so government is sent to the government, RBI sends the surplus to the government after keeping up appropriate contingent risk buffer. So for the 2024-25, the contingent risk buffer was kept at 7.5% and the rest of the surplus was sent to the government by the RBI. So this is the idea. The 616 meeting of Central Board of Directors was done, in which it was decided that we are going to transfer the surplus to the government. Okay, and it was said that we are going to maintain 7.5%. We are going to maintain 7.5% of contingent risk buffer as per the revised economic capital framework. Now the RBI can maintain higher contingent risk buffer. Now, what is this revised economic capital framework? How the RBI, before the limit was 6.5%, but now RBI is able to maintain the contingent risk buffer of 7.5%. How is it so? Which of the following statement is or are incorrect, that you have to tell me in regards to the revised economic capital framework? Try to answer this question. Try to answer this and give yourself 1 mark for each correct answer that you are giving. Okay. So basically, Central Board would have flexibility to maintain market risk buffers at any resilience level within the range of expected shortfall at 99.5% confidence level and 97.5%. There is 99.5% or there is 97.5%, not 98. Okay. The range for buffers for monetary and financial stability risk has been widened to 5.0% plus minus 1.5%. So that is correct, that the monetary and financial stability risk buffer range has been increased to 5.0% plus minus 1.5%. The contingent risk buffer, which includes buffers for monetary and financial stability risk, credit risk, operational risk, would be maintained in the range of 6.0% plus 1.5%. Now tell me that which kind of risk is not included in the contingent risk buffer? Which kind of risk is not included in the contingent risk buffer? If the options are given, then which is the kind of the risk that is not included in the contingent risk buffer? Try to answer. Anyone? Is it operational risk, credit risk, monetary and financial stability risk, or market risk? It is market risk. Market risk is the risk for which the buffers are not maintained under the contingent risk buffer. So here you can see contingent risk buffer, which includes buffers for monetary and financial stability risk, credit risk and operational risk. The market risk, for these kind of market risks, there are separate balances that are kept by the RBI. Okay, so contingent risk buffer are kept for the other kind of risk, but for market risk there are separate revaluation and the other balances that are kept. Okay, very good everyone. Now here the answer is D, because only the first statement is wrong, the second and third statements are correct. So here you can see we have discussed the complete details about the revised economic capital framework, where we discussed that first of all, Central Board would have the flexibility to maintain the market risk buffers at any resilience level with the range of 99.5% 5% of the confidence level or 97.5% of the confidence level. We have discussed the confidence level in detail, that what is this confidence level, why 99.5% or why 97.5%. So I'm not going to discuss it again, otherwise this session will be never ending. So basically we have discussed this idea clearly in the session itself. Okay, so now coming to the monetary and financial stability risk, the range has been increased to 5.0% plus minus 1.5%, and for the CRB the range is 6% plus minus 1.5%. So that means the lower is 4.5%, that is minus 1.5% of 6.0, 4.5%, or the higher is 7.5%. So CRB, maximum of the CRB can be maintained at 7.5% of the balance sheet. Okay, so this percentage is as per the balance sheet. Okay, yes, it is as per the balance sheet of the RBI. Now coming to the next question. So Reserve Bank released the web publication Basic Statistical Return BSR on credit by the Scheduled Commercial Bank in India, March 2025. So the yearly data was released for the Scheduled Commercial Bank, credit growth and such. Now on its database this was released. Now you have to tell me that bank credit growth decelerated. That means the credit growth happened. The credit growth happened, but by a lesser rate as compared to the previous year. So as compared to the previous year, this year of 2024-25, the credit growth happened but by a lesser percentage. So what was that percentage? It was 11.1%. Very good everyone. Absolutely correct. So the answer here is 11.1%. So here you can see that the credit growth that happened in March 2025, it was 11.1%. That has the growth of the credit is lower as compared to the previous financial year where it was 15.3%. Next question in front of you is regarding the deposit data. Try to read the question very carefully and try to answer the question. So here the question is saying that Reserve Bank has released the web publication for the deposits. So basically the household sector accounted for the largest share of the Scheduled Commercial Bank deposits at which percentage? At what percentage? Okay, 52.8%, 60.82%, 65.7%, 72.8%, 79.4%. So I'm getting the answer A from all of you. Only Harshal is saying B. Okay, Mukund and Guru Raja is also saying B. I have noted your name. Okay, so now you have given one answer wrong. So all the students that have given one answer wrong, just deduct 1 marks for yourself. The answer is 60.2. That is B. So Harshal, Guru Raja and Mukund. Absolutely correct answer. The answer is B here. Okay, 60.2. So why this data point is important? Okay, you will say that why do I have to remember this? Because in the newspapers the headlines was like this, that bank deposits up 10.6% in financial year 2025. Household sector accounts for largest share of deposits at 60.2%. So as you know that sometimes the RBI directly picks the lines from the newspaper itself. So directly this data point can be asked. Okay, so here also you can see 60.2%. The household sector accounts for largest share of deposits. So direct this line can come in your phase 1 of the examination. Especially in the phase 1, it is more factual in nature. Directly facts can be asked. Okay, so this data point you have to remember. Okay, household sector accounted for the largest share of Scheduled Commercial Bank deposits at 60.2%. The share of female depositors was 20.7% in March 2025. Coming to the 13th question. Try to answer this question. So basically it is regarding your compounding of contravention. So there is a Foreign Exchange Management Act in which there are some 10 limitations that how you can use the foreign exchange. So there is certain limitations. Let's say that you have broken a rule and you have done some contravention, you have done some mistake, you have done some rule that you have broken of the FEMA. So you can have the compounding of contravention. That means you can just by paying some penalty, you can get away with the, you can just resolve the mistake. Okay, and the RBI will not take a stringent measure against you. So if under the Foreign Exchange Management Act there is a contravention that has happened, there is a mistake that has happened, there is a rule that has been broken and that rule is not very serious, so the RBI is saying that okay, we will just penalize you and we will not take other stringent measures against you. So there is compounding of contravention that is allowed. Now under the compounding of contravention, it is said that you will be liable to a penalty. So basically the entity, so or if you are breaking any rule, regulation, notification, direction or other issue issued in exercise of the power under this FEMA Act, or contravenes any condition, or you are breaking any condition, or you are contravening any condition subject to which an authorization is issued by the Reserve Bank, he, that means the person, shall be liable to a penalty up to thrice the sum that is involved in such contravention, where the amount is quantifiable, where the amount is not quantifiable. So where the amount is not directly quantifiable, in this case 2 lakh rupees of the penalty has to be paid, and which may extend to rupees 5,000 for every day after the first day during which the contravention continues. So here the answer is 2 lakh. Okay. Yes, everyone has given the right answer in this case. Very good. So the contravention, the compounding of contravention, we have discussed this in detail, where we discussed that what is the contravention, what is the compounding, how it happens, how, like, what are the penalties that are taken for different cases, what is the resolution period that is given. That means in this period the compounding has to finish. So it is 180 days, I think. Okay. Yes. Any contravention under section 13 except section 3A may, on an application made by the person committing such contravention, be compounded, be resolved within 180 days from the date of receipt of such application. So within 180 days the resolution has to happen of the, like, the compounding process has to finish. So this is the idea. I hope you are very much clear about it. And this compounding of contravention, you do not have to go too much in detail of these directions, but have the overall idea, have the idea regarding the data points spatially. Okay. So now coming to the last question. Now this is the homework question for all of you. So we have come to the last question, that is the homework question. So you have to tell me that out of 14, how much marks you have got. And actually what happened, that the RBI had established a working group to undertake comprehensive review of the trading and settlement timings of markets. So it was said that we have to, like, bring the timings together, or we have to have the like regular timings for the trading and settlement. Okay. So for the comprehensive review of trading and settlement timings of the market regulated by it, there were the working group that was created. Who chaired this working group, you have to tell that. And in May 2025, this working group has released the report regarding the recommendations. So in May 2025, the recommendations were provided by the working group, but we were waiting, like, I didn't cover this in the session because I was waiting for the final final allow that the RBI do. So basically the working group has released its recommendations. Now the RBI has allowed certain recommendations. Only 2 or 3 recommendations have been allowed by the RBI in June 2025, that we are going to discuss in the next RBI notification monthly revision session. So basically the working group released various recommendations, but we will discuss in June 2025, we will discuss that which recommendations have been allowed by RBI. Okay. Now, there is also one announcement that your next session on Wednesday, is going to be the monthly current affairs revision session for June 2025 for your RBI notifications and the RBI website and the RBI press release. Okay. So usually after, like, your session has happened of RBI notification and RBI press releases, the next session should have been of schemes taken by Gurgira sir, but because I have RDA sessions and I have different sessions in the evening time, so we have decided that next Wednesday I will take you, so that you are not, like, getting your preparation hampered. So I will take your session on next Wednesday for your June 2025 RBI notification and RBI press release. That will be your monthly revision session for your RBI notification and RBI press release, so that you are able to cover and you are able to revise the June 2025 notification and press release, and I will be able to take it in the next Wednesday. Okay. So this is the idea. Do give the right answer of this question, and we will discuss the recommendations that have been accepted by the RBI in the next monthly revision session, because then the recommendations are there. Okay. Yes, I am doing well. Thank you. And thank you everyone. And remember that next Wednesday, you will not have the schemes tab session. Next Wednesday, you will have the monthly current affairs revision session with me for RBI notification, RBI press release. Okay. Thank you everyone. Thank you for joining. See you in the next session, everyone. Tomorrow, okay, let me tell you that tomorrow we are going to do the financial inclusion index that is recently RBI has released. So this is very important. So NABARD grade A students, RBI grade B students, RBI grade A students, whichever, like if you are preparing for these examinations, so do join tomorrow's 10 a.m. session, because tomorrow we are going to discuss the financial inclusion index, which is a very, very important index. In NABARD, it has come in the descriptive part of the examination. In the RBI, it always comes, or it regularly comes in the phase 1, in the phase 2, in the objective part. So tomorrow let's discuss the financial inclusion.